How do you adjust a losing ratio put spread? Have you ever found yourself in a tricky situation with a ratio put spread? It can be challenging when the market moves against you. Let's break down how to adjust a losing ratio put spread effectively. A ratio put spread involves buying a specific number of put options at one strike price while selling a larger number of puts at a lower strike price, all with the same expiration date. This strategy is often used when you have a neutral to slightly bearish outlook on a stock. However, if the stock price falls significantly below the short put strike, it can lead to losses and increased risk. When you find your ratio put spread losing money, there are several strategies to consider. First, you can roll the short puts down and out. This means buying back the short puts that are deep into money and selling new short puts at a lower strike price with a later expiration date. By doing this, you can reduce your risk and give the trade more time to work out. Rolling out in time can also help lower the chance of immediate assignment and may bring in additional credit to offset losses. Another option is to add long puts to hedge your position. You can purchase additional long puts at strikes below the current short puts. This creates a wider protective spread and caps your downside risk. Essentially, this adjustment turns your position into a more traditional bear put spread with defined risk, which limits further losses if the stock continues to decline. If the situation looks dire, you might consider closing the position partially or fully. If your outlook on the stock has changed or the risk seems too high, closing some or all of the losing legs can prevent further losses. For example, you could buy back some short puts while keeping part of the original position intact. Another adjustment could involve converting to a different spread. You can change your strategy to better fit the new market conditions, such as a butterfly spread or a calendar spread. This may help manage risk and potentially recover some premium. Lastly, it is essential to monitor and manage early assignment risk. Since a ratio put spread has more short puts than long puts, there is a risk of early assignment on the short puts if they become deep into money. Adjusting by rolling or closing short puts can help manage this risk effectively. In practical terms, the goal of adjusting a losing ratio put spread is to reduce risk exposure, limit potential losses, and adapt to the new price movement of the underlying stock. Understanding the risk profile is vital. The position profits if the stock price stays near the short strike at expiration but can suffer large losses if the price falls for below it. Timely adjustments are critical when the underlying moves sharply against your position.